We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals.
That was Fed Chairman Jerome Powell speaking on interest rates. And anybody that is wanting to invest in bonds, that's what today's video is about, knows that bond prices are at sky-high valuations. Right here we have LQD, which is the corporate bond ETF, the largest one out there. The corporate bond levels are at sky-high prices. And you can see even the year chart here, very high, at all-time highs, recovering very well from this pandemic. And if we look at TLT, which is a treasury bond ETF, look at treasury bonds provided by the U.S. government, they are at sky-high prices, highest levels that they've ever been at. And in this environment, when you have Jerome Powell talking about keeping interest rates at zero and that they're not wanting to change them anytime soon, people that are wanting to invest in bonds should be very weary about investing in them. So about once a month, I like to go over treasury bonds and corporate bonds and just give my opinion on them. While in my portfolio, I currently do not own any bonds. In a normal environment, I usually would like to own some bonds for some more stability and some more defensiveness in my portfolio. But right now, I do not own any, and I want to just briefly go over why I do not own any and why I don't think you should be owning any either right now in this current environment. But thank you for joining into the channel. My name is Jordan. If you're not familiar with me and my channel, I track my annual and monthly dividend income through these charts, as well as my portfolio value and my monthly YouTube income. And next week, I will be updating these charts. So go ahead and subscribe if you're interested in following along with that. And there's my YouTube income broken down by category. And if you want to support the channel, we have 52 people signed up. So go ahead and use this referral link and get signed up. And you can get $10 just for signing up and depositing $100 to the platform. And if you want to see my portfolio, I currently own 26 different equities. And if you want to see them, they're right here. If you want to pause the video, and if you want to see it for yourself, if you want to load it up through my link on M1 Finance, this is shared in the description. But thank you guys so much, and let's go ahead and get into the video. If you go ahead and look at this quote here, U.S. Treasuries and other government bonds now yield less than what you can get for many dividend-paying stocks, and that might not cushion a portfolio from stock market setbacks as you might expect. A traditional portfolio mix allocated to around 60% stocks and 40% bonds could prove disappointing. What's the rationale for bonds when yields are close to zero or even negative? It's simply an asset class with no positive expected returns. Now, if we go ahead and look at this is the federal funds rate. When we watched that video about Jerome Powell, when he was talking about interest rates, he is the Fed chairman. He is the main guy that decides what this interest rate level does for the federal funds rate. Now, basically, the lower it is, the better it is for equities, the better it is for stocks, the higher price returns that we typically see. But for people that are wanting to be more conservative, have money in a savings account, invest in a treasury bond, have other types of fixed income assets, this is usually a very, very bad thing. And right now, as of the beginning of 2020, after they cut the rates, it is at 0.05%, so essentially zero. And we know right now that interest rates can do nothing but go up. So interest rates and bond prices had inverse correlations. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. And that is why you're seeing these massive share price appreciation for TLT, QLD, and a lot of other corporate bond and treasury bond ETFs alike. That's what this huge price movement up is about. Now, here's what we know. The Fed has announced that they are not going to be lowering interest rates to negative levels. A lot of other countries have tried doing the whole negative interest rate thing, and I don't think it would be something that would even be remotely healthy for the United States. Thank God they're not looking at doing that. But we know that right now, interest rates can only do one thing. Up. They can't go down. They can't go negative. They're already essentially at zero. So right now, all they can do is go up. So what happens when interest rates inevitably do get raised? Who knows when that will happen? I know right now the Fed is targeting 2023. That is their goal for what they're looking at right now. But whenever they get raised, these bonds are inevitably going to go down. TLT, EDV, LQD, a lot of these ETFs have nowhere to go but down. So if you're wanting to invest in them now, you're not only getting a very small dividend yield, like for example, LQD right now yields under 3%. And if you're wanting to buy a long-term treasury bond, you're yielding under 2%, currently 1.6%. So if you're wanting to invest in these are not the type of yields that you're wanting to be investing in. And typically, these share prices are going to go down over the course of the next 1, 2, 3, 4, 5 years. So in my opinion, I think it is a much better environment to invest in equities. Now, if we go back to this article here, let's go back to this paragraph. U.S. Treasuries and other government bonds now yield less than what you can get from many dividend-paying stocks, and they might not cushion a portfolio from stock market setbacks as you might expect. So next time we have a stock market crash, whenever that is, let's say that it happens sometime between now and the next 3 years, these bonds are not going to be able to appreciate in price the same way that they normally would from a recession because interest rates cannot get lowered anymore. Now I want to show you some comparisons of this. I just want to show you some of the top holdings that I look in my portfolio. Let's look at my top holdings here. So we know that interest rates for bonds are yielding about 2% roughly. Well, let's look at some of my top holdings and compare some of my equity holdings compared to bond stocks. So if we look at Broadcom is a technology stock that is growing very rapidly. It currently yields 3.6%, and they're due for another dividend raise in about 2 months from now. So I'm sure that's actually somewhere around 4% after they price in that raise in the next month or two. Let's go to the next one. Let's look at my second largest holding. Let's go to Realty Income. This is a real estate investment trust, which, by the way, real estate investment trusts usually appreciate in price in low interest rate environments. Has nearly a 5% dividend yield. Let's keep going. Let's keep on going further. My third largest stock, Southern Company. Utility stocks are very safe in recessions. They are usually very defensive. Just like a bond, they do not have nearly as high as a beta as a lot of other equities do. These will probably be shielded from most of the stock market crash, and while they do typically go down, they usually don't get hit nearly as hard as a lot of the other equity stocks do. Now this currently has a 4.3% dividend yield, which is growing every year, which has already been raised in 2020. Now let's look at one last one. This is another real estate investment trust. This is one that I've been talking about a lot recently. Very undervalued in my opinion. This stock has raised its dividend 3 times in 2020. So that's the equivalent of a dividend slash interest payment from a bond. If you're owning an equity, you get dividends. So if you're wanting to invest in equities, you could invest in something like a WP Carey that has already raised its dividend 3 times in 2020 and is already looking at a 4th raise in 2020. And this currently has a dividend yield of almost 7% versus investing in a treasury bond where you can get a whopping 1.6. So if you go to this research tab here and you click funds and then you sort by bonds and you look at domestic, it doesn't matter if you're looking at corporate or if you're looking at governmental, whether you're looking at BND or AGG or BSF, LQD, a lot of these top ones, usually typically speaking, they're not the best ones to invest in. And in my opinion, while typically it is a good idea to have some bonds in your portfolio if it helps you keeping out of selling out of your portfolio, but right now it's not the best time to be owning a lot of treasuries or a lot of corporate bonds because they just don't have the upside potential that they normally do. But before we end the video, I just wanted to show you guys one quick thing in my portfolio. I wanted to show you how the market's been doing and comparing this to treasury bonds and a lot of other things as well. Go ahead and look at things like SPY. Let's look at the S&P 500 and compare it to a lot of these other bond ETFs, okay? Let's look at LQD, for example. LQD over the last 5 years is up 15.2% with a dividend yield that is almost exactly that of the SPY, a little bit higher. Now it's up 15%, and let's go ahead and look at things like TLT. Let's look at a 30-year Treasury bond ETF. 1.6% yield and is up 40% over the last 5 years. But if you were just to invest in just the basic S&P 500, you would have performed a 43% return, outperforming that with a growing dividend payment every single year. Not to mention, if you were to invest in pretty much any of the tech giants out there, let's go ahead and look at the QQQ. The QQQ is up 120%. The NASDAQ is up 120% in the last 5 years, far outperforming any of that compared to any kind of treasury bond ETF or anything like that. But I will say I will be updating you guys as we go along. Like I said, I like to go over this about once a month. The interest rates really determine pretty much all the performance of these treasury bonds and most of these corporate bond ETFs. And I really think that a lot of them are overbought. A lot of insurance companies, a lot of banks, a lot of hedge funds has been hedging their bets with these ETFs. And I'll be following along every single month, giving you guys an update on these bond ETFs. So if you want to follow along with me, like I said, I track my annual dividend income, my monthly dividend income, my portfolio value, my monthly YouTube income, and all that jazz every single month, and I'll be updating this next week. So I'd invite you to subscribe so you can follow along with me on that. And like I said, I am fully transparent. I show my buys, my sells, my winners, my losers, my dividends, my every single thing that you could possibly imagine in my portfolio, including my YouTube income, something that hardly any other YouTubers out there disclose. And like I said, if you want to follow along with me, you can use this referral link down in the description. We have 52 people signed up. Let's go ahead and try to get that number to 53, and you get $10 just for downloading this link and then signing up using this referral link. So thank you guys so much. You've made it all the way in. If you have any comments down below for me for anything about interest rates, bonds, anything in general, I'd love to answer them. So go ahead and leave them down in the comment section if you're interested down below. But thank you guys so much, and I'll talk to you guys next time.